Hi, welcome. I'm Professor Ashok Patil. Today we are going to talk about corporate valuation second module. The second module is drivers of value. So what do you understand by the term value? We talk about value so much, valuing a company, valuing a stock, valuing rates, and so many things, value of assets. But what is meant by value? In financial terms, value is the present value of future cash flows. The present value calculated of these future cash flows has to be discounted by appropriate cost of capital. The cost of capital we'll be seeing in the next module, but this module is talking about the value which is important to calculate because we need to take the decisions regarding mergers or acquisitions, buying and selling of assets. Now let me write this on the board. The value is present value of future cash flows discounted at an appropriate rate. Now you can see that in this definition we are having certain important things. One is that it's the present value. Therefore, what we did in the first module, the time value of money will come into picture. Second thing, the future cash flows. Now remember the word future. That means we have to forecast the cash flows of the company's revenues, costs and profits, and all this has to be forecasted based on the past values of the company's performance, and also should be accounted for future prospects of growth of the company. The third part is to be discounted at an appropriate rate, and that appropriate rate is going to be WACC, weighted average cost of capital, which we'll be saying in the next module. So for this module, we are going to focus on present value of future cash flows. Now, if I were to see, this can be written as value is equal to sum of future cash flows of the firm, n starting from 1 to n, this has to be I. So I starting from 1 to n, divided by the cost of capital. So we can see that so what we can see is the value is the present value of future cash flows, right? Simply put, we need to calculate first the future cash flows, calculate the WACC and use this formula and other concepts from the time value of money to arrive at the value of the company. Now we are going to talk about today what this value and from where this value comes from. Are there any factors which determine the value of a particular asset or a firm? So in case of the firms, the two factors which predominantly come, we are going to derive those factors from the equations, basically from this equation, and see that how the future values are calculated and also what are the two factors. Now the two factors which come out, although we'll be looking at it in detail later on how these factors come out, are ROIC, return on invested capital, and the second one is the growth growth of the free cash flows is what we are going to look at. Now we have seen these two factors, that is the value is coming from two factors. One is return on invested capital and the second one is growth. So what drives value is the growth and ROIC. So you can see it here, the future cash flows is dependent upon the growth and ROIC of the company. Now what is ROIC? Return on invested capital. What is ROIC? Now we have seen the return on investment in general, but we need to look at the return on invested capital from the perspective of valuation. Now we are going to write those equations. So you can see that the return on invested capital is equal to no PAT divided by operating capital. Now you see that return on invested capital, we are talking about net operating profit after tax divided by operating capital. Now this needs to be explained, but then let's look at that, the first factor, which is no PAT. Normally we talk about return in terms of the net profit, but here we are talking about no PAT. That is because we want to calculate the cash flows generated by the operations of the firm and then take the present value of them. And the operating performance of the company is captured in the no PAT. So no PAT also can be written as EBIT into 1 minus T on operating capital. So you can see it here that ROIC is the after tax operating profit divided by the invested capital. Having said that, what is operating capital? Operating capital is nothing but the net fixed assets plus net operating working capital. Now remember that this is again operating working capital. So what we are looking at is when the company's operating performance is calculated, we have to see that only operating working capital is taken into consideration for calculation of the operating capital. Now why is that so? You might ask. The thing is that when we said value of the firm, total value is equal to value of operations of the company plus value of non-operating assets. So we can see that value of the total value of the firm is equal to value of its operating performance plus value of its non-operating assets. Now what we are doing here is the value of the operating assets. Now having said that, we need to look at how this actual equation can be looked into to look at how these factors are derived. The factors which are, we are talking about ROIC and growth. Now we are going to look at that, but with the example on some firms, which is like this. Suppose there are two companies. The company 1 is the value company and the company 2 is volume company. And these two companies are having same earnings but different cash flows. You can see that how the company's revenue is growing at a constant growth rate. This is, in this case, it is 5%. So from year 1 to year 2, the cash flow is increasing by 5%. So 1000 is the revenue, it goes to 1050. The earnings are 100. Second year, the earnings are 105. And to generate these 1000 revenue, company has invested 25 worth of assets. Now you can see that the revenue generated and the earnings require the investment of 25. So if earnings are 100 and the investment is 25, cash flow generated is 75. Now look at the volume company, where you can see the revenue is same and growth rate also is same, that is 5%. So 1000, 1050, 1102, 1158 and 1216. Look at what is happening to the earnings. The earnings also remain the same. However, this company, volume company, to generate 1000 of revenue, it is investing 50 worth assets. That means the volume company is requiring double the investment to generate the same revenue. Obviously, you can see that the cash flow generated by the company, value company, is 75, 79, 82, 87 and 91, whereas the cash flow generated by the value company is 50, 52, 55, 58 and 61. Now we can see that the amount which is required to generate this revenue is called investment rate. The investment rate is the amount required to generate the earnings of the company or revenues of the company. Now investment rate in this case is 25%. You can see that this 25% of this. And since the company's other factors assumed to be remaining constant, we can see that the 100, 25% of 100 is 25, 25% of 105 is 26, 25% of 110 is 28, like that it will go. Similarly, here it is 50% and 50% of 100 is 50, 100, 50% of 105 is 53 and so on. Now we can see that the investment rate is different for these two companies. By looking at the investment rate itself, one can actually guess whose value or whose cash flows will be more. In this example, we can see that the cash flow generated by the value incorporation is more than the volume, and therefore we will be seeing that this company's value will be more. Okay, all right. But meanwhile, we need to see that how actually growth also comes into picture. The formula for growth is ROIC times investment rate. Growth is ROIC times the investment rate. So what we are looking at is growth is investment rate into ROIC. Right? Now this is the equation, and the other one which we saw was the ROIC, return on invested capital, was nothing but NOPAT divided by operating capital. Now you can see that this ROIC can be plugged and you can derive other equations, but then can you calculate what is the ROIC for this value company? The ROIC for value company is going to be investment rate into ROIC, right? And growth is given. So in fact, from this equation, ROIC can be calculated. The ROIC is equal to growth upon IR. So we can use this equation to calculate. Therefore, ROIC is equal to G upon investment rate. Now from this equation, that if growth is 0, obviously the ROIC is 0. But then in the case of ROIC, that is actually constant, not 0. Although this formula can be used only for 1 year. So when we calculate over the period, we need to see how this equation changes. Okay, now the same example, but with detailed calculations is done here on this slide. You can see that the NOPLAT, net operating profit less adjusted taxes, of the value company for the growth rate of 5% is 100, 105, 110, 25 and so on. For the volume company, it is the same because we are saying that the growth remains the same and the starting point is same. The net investment which is required to generate this 100, remember that we are not talking about revenue here, as in the previous slide, we talked about the revenue here. Here we are talking about only the NOPLAT or the earnings. And you can see that the free cash flow, which is nothing but 75. Now, in order to put all this, you need to see that free cash flow. Earlier course as well, that is nothing but NOPAT minus net investment in operating capital. Now you can see that there is similarity between these two equations. You can see that NOPAT is there and operating capital. So this is a ratio of the NOPAT to the operating capital. This comes in terms of percentages, and whereas this is the amount, free cash flow is equal to NOPAT minus net investment in operating capital. So there is a difference between what is the NOPAT and the amount of investment which is required to generate this NOPAT. Now, as we know, NOPAT also can be written as EBIT into 1 minus T, that is post-tax performance of the company minus net investment in operating capital. Right, now we can see it here. The free cash flow is calculated, that is EBIT into 1 minus T minus net investment gives you cash flow. The cash flows are calculated for all the years. Second, ROIC, as we can also calculate from the previous discussion, that it is a change in the EBIT, NOPAT, you can see that here, NOPAT, divided by the net investment required. And when you calculate, it becomes 20%. And you can observe that the ROIC, return on invested capital of the company, is remaining constant. Now, we need to pause here a bit to just recap what all we have seen. There are so many equations, one has to relook at it before we proceed. So what we are saying is that value of the operations of the company is equal to free cash flow and present value of free cash flow to be calculated. Okay. Now what we are looking at is what is free cash flow. So you can see that free cash flow is equal to NOPAT minus net investment in operating capital. Meanwhile, we are also seeing what is operating capital. Operating capital is equal to net fixed assets minus net operating working capital. Now we can see that we are actually calculating the value using this formula from the time value of money. This is the forecasted cash flows of the company. This is the weighted average cost of capital, and sum of that is FCF, that we need to calculate free cash flow. And how the free cash flow is calculated is NOPAT minus net investment in operating capital. NOPAT also is calculated like EBIT into 1 minus T. Right. So now you know that free cash flow is dependent on EBIT of the company, that is earnings before interest and tax, minus the net fixed assets minus net operating working capital. Now you can see that these terms are only referring to FCF. So we are calculating the numerator of this formula. And when trying to see that how this formula actually works in the background in terms of the value company and volume company. Now we have seen that the free cash flows which are calculated are here, right? And then ROIC, is also calculated. So ROIC, the ROIC is nothing but NOPAT divided by operating capital, right? Now we will be solving the problems on each one of these when we actually start the module, but this is just an overview. So we can see that value, free cash flow is dependent on the EBIT and operating capital, and the other term to calculate the similar uh, performance is ROIC, return on invested capital, is NOPAT upon operating capital. Now look at what is happening to the investment rate. Now investment rate obviously is net investment required, right, divided by the amount which is NOPLAT, earnings. So investment rate, now maybe I can write it here. Investment rate is equal to investment required divided by NOPLAT or NOPAT. Remember that NOPAT and NOPLAT are used interchangeably, although there is a small difference, but we will go ahead with using these terms interchangeably. So you can see that the amount of investment required to generate this amount of NOPLAT is your investment rate. Okay, so now in the case of value company, we can see that investment is 25%, which remains constant. The growth which is given is 5%. You can see it remains same. Now you can see that the ROIC, which we calculated here, NOPLAT 1 minus NOPLAT 0 divided by net investment, can be also written in terms of growth formula, right? In terms of growth. So NOPLAT initial investment, initial earnings multiplied by growth divided by net investment will give the same value as 0.20, 0.20. You can see that this is same. So there is alternate formula to calculate ROIC, that is NOPLAT into growth. So using the growth, you can actually calculate that. So if you can see that this NOPAT is the difference between next and past 2 years. That is when we talk about NOPAT 1 minus NOPAT 0, right? And this is the operating capital which is required in the beginning. Now, this NOPAT 1, I will just rub this off and I can calculate, write it here. So from here, NOPAT 1, what is NOPAT 1? NOPAT, that is NOPAT for the next year is NOPAT for the previous year multiplied by 1 plus growth rate, right? If I substitute that here, then I can calculate ROIC is equal to NOPAT. Instead of NOPAT, I am going to write NOPAT 0 into 1 plus G and minus NOPAT 0 divided by operating capital. And then you can see that if I take NOPAT 0 outside, and I can see 1 plus G minus 1 divided by operating capital. So NOPAT 0 into G divided by operating capital. Now this particular formula is actually used here to calculate this. So NOPLAT 0 into G divided by net investment in the beginning. So you will get the same. Now as we have seen earlier, the other formula which is in terms of investment rate is investment rate is equal to growth upon ROIC. So you can see that 0.25. So investment rate can be calculated using two formulas. ROIC can be calculated using two formulas. So this is for the value company. Now you can see that the same thing is done for volume company, in which case the return on invested capital is 10, and you can see that the growth rate is same constant for both the companies. The ROIC is 10% calculated in two different ways, and the investment rate is calculated in two different ways. So you see that the investment rate of this company, volume company, is more, and therefore the free cash flows generated by the value companies are more than the volume company. Now, more or less what I have written on the board can be summarized here. You can see that value is equal to free cash flow, and WSCC minus G. Now you will wonder, this is the annuity variation of the same formula which I wrote earlier. So you can see that this is the annuity perpetuity case, and growth is what we saw in earlier example as 5%, and free cash flow of the first year. Right, so you can see that value is equal to FCF upon WSCC minus G. Now you can simply see that FCF is equal to NOPLAT into net investment in operating capital, which we saw there on the board as well. Now we know that investment is equal to net investment upon NOPLAT, and therefore net investment is equal to IR into NOPLAT. If you substitute this net investment, this formula IR into NOPLAT, you can see that IR into NOPLAT is here, and you solve it to see that it comes as NOPLAT into 1 minus IR. But we have seen IR also is equal to G upon ROIC. Earlier, we also saw that the IR is equal to G upon ROIC. If I substitute that here, the equation comes FCF is equal to NOPLAT 1 minus G upon ROIC. And if I put this formula here, the value formula looks like this: NOPLAT into 1 minus G upon ROIC divided by WSCC minus G. So I'm just going to write that whole equation here on the board, and then we'll explain and see the variation and impact of the change in the growth and ROIC on the value of the company. So we started with the value, which is nothing but free cash flow. Now I'm going to use the perpetuity formula N divided by WSCC minus G, and then you can see the final thing which we calculated was value is equal to NOPAT 1 minus G upon ROIC divided by WSCC minus G. Now certain questions. What happens if G increases? If G increases, whether the value will increase or decrease? Now see the impact of this. If G increases, this portion, assuming other things remaining constant, if G increases, this right hand side portion G upon ROIC also increases. If that increases, this amount 1 minus G will decrease. G increases, this entire bracket will decrease. If that decreases, NOPAT into 1 minus G upon ROIC also decreases. Therefore, value should decrease only from the numerator point of view. But look at what happens here. As G increases, this WSCC minus G, that is denominator, decreases. If that decreases, the value should increase. So you can see that numerator is actually making it to increase the value, and whereas the denominator is trying to decrease the value. No, sorry, the other way around. And denominator is trying to increase the value if G increases. And you can see that if G decreases, reverse is the case. What happens if ROIC increases? Now that is where we need to rewrite this equation in different terms, that we will write like this: NOPAT into ROIC minus G divided by ROIC, the entire thing divided by WSCC minus G. Now you can see that ROIC minus G and WSCC minus G. So if ROIC is increasing but more than the WSCC, then value increases. Now that we are going to see with a simple example here. So you can see that the same formula, if ROIC is 20%, right, and for WSCC 12%, you can see that for 12%, irrespective of whatever is the growth is 3, 4, 5, 6, 7, 8, 9, so on and so forth, the value of the company remains the same. That means when ROIC is equal to WSCC, you can see it from here also, ROIC is equal to WSCC, both of them are same. The growth doesn't matter, value remains the same. On the other hand, when ROIC is less than WACC, so WACC is 12% and ROIC is 7% and 10% respectively. As the growth opportunities are there, you can see that the value is decreasing. So the value decreases if ROIC is less than. But look at the other positive side. When ROIC is greater than WACC, you can see that the value is increasing. So you can see that in this slide as well with different example. And if you can see that if ROIC is equal to WACC, growth opportunities don't matter. If ROIC is greater than WACC, then growth opportunities add value. If ROIC is less than WACC, growth opportunities erode value. So I think we'll stop here to understand once again what is value. Value is the present value of bundle benefits which are generated in future. Right? In the case of firms, value is present value of future cash flows of the company discounted at an appropriate rate. Also, we have seen that the value can be also written in this advanced formula using the ROIC and WACC and time value of money formulas, and we can see that value is dependent on growth and ROIC, and we concluded that the companies whose ROIC is greater than WACC should focus on growth opportunities because the value increases for such opportunities. The companies whose ROIC is less than WACC should focus more on increasing the ROIC more than WACC rather than growth. So such companies whose ROIC is less than WACC should not go for growth opportunities but try to increase their ROIC. And the case where ROIC is equal to WACC, growth opportunity doesn't matter. And you can see that this conclusion very much from these formulas, right? And I think that's how we'll stop here for today. Thank you.